Hey everyone, how's it going? So today I thought I would go over a debit spread that I made in Tesla back in late July, and this trade lasted for 3 days, and we closed it for over 100% profit in 3 days. We opened this trade on July 29th, which is a Thursday. We closed it on August 2nd, which is a Monday. So we were in this trade for 3 days, and we closed it for over 100% profit. Actually, it was 113%. And this is basically a $10 wide debit spread that we entered. We bought the 760 call, sold the 770 call for $1.17, and then 3 days later, three trading days later, we closed that same spread for roughly 250. So if you'd like, I will show you how I did this, how I found this trade, and basically the scan that I like to use the most, or I'm sorry, the indicator that I like to use the most is probably the Ttm Squeeze here. I know in my Patreon group and on my Discord channel, um, I pretty much talk a lot about those, or the Ttm Squeeze, just how often I use it. And I guess just a quick overview of how the Ttm Squeeze works. Um, we can see in the center here we have this green line, or I'm sorry, green dots and then red dots. And anytime you have the red dots here, it basically means the stock is in some sort of a consolidation period, or what they term as a squeeze. And normally, once you go through this squeeze, you normally will have a large move, either up or down. And if we are above this line, we are going to be trending upward. And if we are below this line, we're going to be trending downward. Another thing is we can see that we have two colors of bars on the top side of the line, and then we have two separate colors on the bottom side. So on the top side, we have the light blue and the dark blue, and the light blue basically means that there's a lot of upward momentum um, in the stock at the moment. Once it starts to turn dark blue, that means that basically it's starting to consolidate. Basically, that momentum is fading away. It doesn't mean it's going to go all the way. We can actually see where, we came up, we traded flat, then we went up again, and then traded flat, and then went down. And we can see that's basically what happened here. We came up, we can see the momentum slowed down, then we came up again, momentum slowed down again, and we can see that we crossed over from the top to the bottom side right here, as well as being in a squeeze. And then we can see that the stock dropped substantially right in here. And the trade setups that I like to look for is going to be when you go from a red to a yellow bar. Normally, when you go from a red to a yellow bar, that's normally you're going to either trade flat or go up. But you're really going to have to just look at each individual stock. Some stocks can go from red to yellow and just keep going down. So you have to look at your stock and see what your stock has done in the past. Tesla so far, once it goes from red to yellow, it normally trades flat or goes up. So now if we want to get into the setup of this trade, that basically kind of explained, I guess, a brief description on how the TTM squeeze works. I would actually recommend that you watch John Carter's The Squeeze video on YouTube. He's got about a 30-minute video explaining how to trade this. That was just a little 3 to 5 minute brief video on how I use it. His video will go into much more detail on how to use this. What I normally do is I like to look at stocks, look for trading opportunities after the market is closed. And what I noticed is on the 28th, we went from the red to the yellow bar right here, and we had just had earnings. And earnings was actually pretty good on Tesla. I'm pretty sure they had a positive earnings report. And I noticed that we had the red to the yellow bar here. So what I did is I decided to take a position on the 29th, which was Thursday. And we can see that pretty much everybody must have had the same idea, because Tesla really shot up. We went from 645 to 725 in roughly 3 trading days. And luckily, this is the 3 trading days that I was able to take part in. So what I did is I basically opened up the option chain here, and I went out. I want to say at the time it was about 30 days, and I went to the 30 delta, and I basically just bought a $10 wide spread. Just like that. We can see here, this is the 750, 760. It was $2.40 debit to buy that. But anyway, I bought a a $10 wide spread. But the reason that I was able to get the spread so cheap is at the time, the implied volatility was extremely low for the stock at the time. We can see right here the implied volatility. Looking at this line, we were at the lowest point of that year. I want to say at that time, the IV percentile was 1% or 0%. So the implied volatility was very low. Options were cheap. And anytime the IV is low, you're going to have more success if you're buying options than if you're selling options. So that's what I did. Options were cheap, so I bought options at that time, and we bought the $10 wide spread, the 760, 770 calls, and we paid $1.17 for it. And we bought it somewhere in here on this day. So now let me explain to you why I sold on this day and on Monday. So if I pull up another chart here, this is still Tesla, but now what we're looking at is I have the expected move for each week plotted on the chart here. And this was Thursday, this was Friday, this was Monday. The expected move is basic one standard deviation move up or down for the stock every week. And we can see on this week the expected move was roughly 720 on the high side, and it was right around 655, 656 on the low side. And what this means is there's roughly a 68% chance that the stock is going to stay within this range, every single week. It's 68% chance. So, you still have a 30% chance it's going to go above or below it. But 68% of the time, the stock is going to stay in this range. And when I opened up my trading platform on Monday, I noticed that we were already above this range. We were already at, like, I want to say it was 724 when I opened up the trading app. So I was already above that range. I was already up over 100%. So I just went ahead and closed out the trade because I knew that the probabilities of us keep going higher were actually lower. I knew that we had a higher probability for us to pull back down into this expected range, and that's pretty much what we did. We actually came back in, we closed inside the expected move, and if we would have held on to this trade, we might have made a little bit more money, right here. Well, actually, we wouldn't have because I closed it right in here. So I closed it for the high of the week. The only time we might have made more money would have been right here, but that's hard to say. We can see that the implied volatility was actually a little bit lower right there than it was right here. So we actually would have lost money there because even though the stock may have been a hair higher, the implied volatility would have lowered the price of our options, so they would have been less. So just closing this stock at this time seemed to be a good option at the moment. And I had no idea what the stock was going to do the rest of the week. It could have went up, but I just felt that the probability of the stock staying at this level or lower the rest of the week was going to be pretty good. So I closed out the trade. And it turned out to be a good move because we can see that the stock really didn't do anything the next couple of weeks. Really, the following 2 weeks it traded flat, and then we dropped. It's only started to come back up again just today. So anyway, that's all I have for you today. Hopefully this made sense and was understandable. And thanks for watching, and have a great day.